2022 was a spectacular year for Japan. It started off on a good slate. As the world's third largest economy, the proceedings were going according to forecasts. However, the third quarter of the year changed everything. It was a big shock to the world when Japan's economy unexpectedly shrank. Apart from devastating surprises, it brought about further uncertainties, typically making the population lose faith in the outlook as global recession risks and a weak yen and higher import costs took a toll on household consumption and businesses. One could assume the country's economic forces were hooked in a game of yo-yo as the July to September data revealed that the gross domestic product tanked to an annual of 1.2%. It was a dramatic turn of events compared with economists' median estimate for a 1.1% expansion and a revised 4.6% rise in the second quarter. This downturn can best be defined and summarized as a quarterly decline of 0.3% versus a prediction of 0.3% growth. How does this make the year 2022 spectacular, you may ask? Well, this is because the 2022 economic fall is the worst currency crisis Japan has experienced in years. Decades, in fact. The incident is quite unfortunate and the news disheartening. Japan's ill financial market really did begin as a consequence of the COVID-19 crisis. As at 2022, the country will still be in its healing phase, in a process of navigating its recovery from the pandemic. The Ukraine war, which kicked in immediately after the COVID-19 crisis, also came with economic implications. Japan hit accelerated inflation with a hike in prices of commodities, mainly as an effect of an increase in import prices or downright scarcity of products who didn't make it into the country due to the tight regulations. The world's third largest economy continued to struggle and faced intensified pressure from the red-hot global inflation and the sweeping interest rate increases worldwide. As time went by, the government gradually began relaxing COVID-19 related restrictions. Then it was really safe to anticipate a resultant boost in the economy, which is why the news of the contraction of Japan's economy in the third quarter of 2022 came as a huge shock to the whole world. The contraction was a surprise, said Takeshi Minami, chief economist at Norinchukin Research Institute. The lifting of the COVID-19 restrictions offered some relief, but the outlook was clouded by uncertainty over fresh virus cases, he reasoned. The only logical conclusion for Japan's predicament is that while COVID-19's domestic impact shrunk, other economic challenges grew. After decades without significant price increases, Japanese companies and households are having to deal with inflation caused by the breakdown of global supply chains and rising food and energy costs due to the Ukraine war. Although the price rises, which were around 3% year over year in September, are low compared with those in many other countries, they have come as a shock to Japan, which has long been accustomed to price stability. As if in an attempt to prevent the economy from thriving, the pressure on Japan's economy got worse as the yen, like other Asian currencies, has fallen dramatically against the dollar over the last year, compelling the Japanese authorities to intervene in currency markets in an effort to shore up its value. While it's believed that no society will deliberately engage in processes that will deplete and ruin their economy, Japan's self-made decision on interest rates seemed to have brought calamity upon them. Economists say the fall can be attributed to the Bank of Japan's decision to keep interest rates low. The United States, on the other hand, has repeatedly raised its interest rate, creating a wide margin between it and Japan. This difference in rates has driven a sell-off of the yen, making it relatively cheap as investors pile into the dollar in search of higher returns. It's not all bad news, though, as the cheap yen has had some benefits for Japanese exporters, whose products are less expensive for customers abroad, as well as for other Japanese companies with large overseas earnings and investments. But the pluses seem to have been outweighed by the stress put on domestic markets, as businesses and consumers alike have had to pay more for imports, whether raw materials or finished goods. Notably, the yen's weakness has created record trade deficits for Japan. The value of imports increased by nearly 45% in the first half of the fiscal year between April and September as the price of fuel skyrocketed. Exports, unlike the imports, they rose by a little below 20%. Still, Stefan Angrick, a senior economist at Moody's Analytics, described the news as counterintuitively good news, writing in a report that the pickup in imports in the third quarter shows that Japan's belated COVID-19 recovery is gaining traction as businesses and households return to spend. Before this period, the Japanese economy was known for persistently low inflation despite the known global inflationary period. This is one of the reasons the Bank of Japan views the current inflation in Japan as temporary and maintains its expansionary monetary policy. Indeed, there are a lot of questions about why Japan has experienced much lower inflation than the rest of the developed world for so long. Two macroeconomic factors are responsible for this. The first is the very low exchange rate depreciation, passed through to inflation, and the other is low wage growth. A weaker yen has far less impact on inflation and the economy than macroeconomic analysis predicts. The Bank of Japan kept its policy rate negative, while other developed countries raised interest rates to combat inflation, causing the yen to fall by 30% against the US dollar. Currency depreciation should cause inflation by driving up the price of imports, yet the weakness of the yen in the absence of high inflation demonstrates the low impact of depreciation. Low wage growth is another factor. Despite a 2.6% unemployment rate in September 2022, wages have not kept pace with inflation as opposed to the other countries where increase in the price of commodities encouraged increase in wages. Undoubtedly, the fall of Japan's economy has had grave effects on global trade and the financial market. In a jolt, the risks to Japan's outlook have risen, bringing the country to the brink of a recession. The country's economy minister, Shigeyuki Goto, said a global recession could hit households and businesses. You see, in the third quarter of that phenomenal year, private consumption, which makes up more than half of the Japanese economy, grew by 0.3%, a slight increase above the proposed estimate of a 0.2% growth. But at the same time, it was a sharp fall from the whopping 1.2% gain recorded in the second quarter of the year. The data suggested that consumer spending will remain pressured over the months following, with real compensation of employees falling by 1.6%. Could there be a solution to this? We hope so. Experts have a lot to say on this. Growth should turn positive amid a rebound in inbound tourism and a smaller trade deficit, but the eighth virus wave and rising inflation will limit the recovery, said Darren Tay, Japan economist at Capital Economics. Tay noted that non-residential investment increased by 1.5% on a quarterly basis. This was below expectations and Capital Economics' own estimate for a strong 3% growth rate. While the rise of inbound tourists is a bright spot for October to December and beyond, we see downside risks from the rising price of goods and the fear of another outbreak, he said. Highlighting concerns about a resurgence of the pandemic, Japan may face new daily COVID-19 infections in the hundreds of thousands, Fuji Television reported. Cases have been on the rise in recent weeks in what some authorities have called the eighth wave in the course of the pandemic. According to Darren Tay, the year 2023 will be a tough one for Japan. In his speculations, Japan will be dragged into a recession by a global downturn that will greatly affect exports and business investment. In a bid to provide a solution, Prime Minister Fumio Kishida's government is stepping up support for households to ease the effects of cost-push inflation, with 29 trillion yen in extra spending in the budget. The Bank of Japan has also maintained its ultra-loose monetary stimulus program to help revive the economy. On the other hand, Japan is an ongoing adjustment to pandemic life. The reopening to tourism in October and a large government stimulus package meant to relieve the effects of inflation are all likely to contribute to a modest continued recovery in domestic consumption. Business investment also looks set to continue growing as Japan pushes forward efforts to digitize its economy. This means that despite the unexpected setback, it's quite certain that the economy will return to positive growth. Positive or negative, world economies are ever-changing. To keep up with these changes, watch out for this space. It's easier if you subscribe and turn on your notifications. Also, don't forget to like this video and drop your comments below. Until next time.